Welcome back to the concluding part of our discussion on share-based payments. Today is Sunday, the 9th of May, 2021. We have started our discussion yesterday, which was Saturday, the 8th of May, 2021, on the requirement of IFRS 2 with respect to share-based payment transactions. Okay, today we'll more or less start by refreshing our memories with some exercises with respect to what we discussed. And today we are going to more or less move towards having to conclude on our various discussions regarding the following. One, modifications regarding share-based payment transactions during the vesting period. Second, we'll look at cancellation and how it is required to be treated during the period of during the vesting period. We'll also move towards discussing issues as regards share-based payment within a group and how it affects group accounts. Okay, we also move further to discuss share-based payment with respect to the impacts on deferred tax computation for an entity that has such a transaction existing in its books. All of these are what we're going to discuss in the course of our discussion today. And we'll wrap it up with the disclosure requirement in line with IFRS 2. Welcome once again to this session. And I'll more or less open the floor with one or two comments about what we've done so far. And based on what we have done yesterday and up to today, what new things have we come across? What interesting things have you seen? And what perspective are you willing to consider in our discussion today? Welcome on board. The floor is open for you guys to contribute.
Okay, thank you very much, sir. I must confess it's been very, very interesting since we started yesterday. Like, it's not as if we didn't do something related to share-based payments when we were attending ICANN classes. But you know, this is quite different. This is taking it beyond what I expected, especially having to know how to arrive at the fair value and the intrinsic value, which is very, very key. It's laid the foundation for the whole understanding of share-based payments. And the way you also took it one after the other, even when we started the accounting for share-based payments, though it's something that we had like residual knowledge about, but it comes clearer. It's something we could easily relate to it. And even without studying so much again, I think I can go ahead and solve any problem relating to share-based payments, whether equity settled or cash settled, because the understanding is clear. It's not as if I crammed it or I rushed to learn it. So this is something that it was explained step by step. So it's something I cannot forget. So I really appreciate you for that. And I know that today again, you will take us further and we understand better accounting for share-based payments. Thank you.
Another one?
Yeah, thank you very much, Mr. Muiwa. In fact, having gotten this knowledge yesterday, I was full of joy to understand the concept of share-based payments more than I do before. As a matter of fact, I had it in my dream that I was solving solution on share-based payments. But having said this, like we were given three exercises to deal with yesterday, and I encountered challenge when I was solving the first one, because like you gave us the step-by-step approach, I actually adopted the approach, but there was a technical area where I have a notion that I get the question correctly, but I was having challenges to determine what intrinsic value will be, having assumed that the question is relating to cash settled. And I believe with the knowledge I've acquired, which I strongly believe that you will shed more light to all those gray areas today as well. Thank you very much. I really appreciate your help. I really appreciate your time on this particular topics. Thank you.
Okay, thank you very much. Anaru was unable to join us yesterday, and I believe over the night you've taken time to watch the video. If not, don't worry. Once you have access to the video, you are home and dry. And also the workbook, the notebook, and other things have been sent to you guys also. I believe that's going to assist us. If you have any other comment, Anaru, so that I won't be able to attend to any other comment again, because we need to move on.
I don't have any comment. I've not watched the video. I just going to download it after this lecture and this one, so that I will go through it.
Thank you very much. Okay, let's continue. Let's just on a lighter note, let's start with what I mentioned briefly yesterday. Glasgow's model, DSM, where we'll make use of it in valuing option, especially with respect to call option. It's also applicable for put option, but again, the option we are looking at here, it's issue of call, which relates to share-based payment transaction, where employees can call up to buy the shares by exercising their rights once it vests or do otherwise. Okay, I want someone to take us through the Glasgow's model, which is a leaf we are borrowing from the finance and derivative profession or industry. Who will more or less say one or two things about what is on the screen. I want you to read it up so that we can discuss it briefly before we proceed.
Okay, Glasgow's model. When the price process is continuous, that is, price changes become smaller as time periods get shorter, the binomial model for pricing options converges on the Glasgow's model. The model, named after its creators, Fisher-Black and Myron Scholes, allows us to estimate the value of any option using a small number of inputs, and has been shown to be remarkably robust in valuing many listed options. The model, while the derivation of the Glasgow's model is far too complicated to present here, it is based on the idea of creating a portfolio of the underlying asset and the riskless assets with the same cash flows and hence the same costs at the option as the option being valued. The value of a call option in the Glasgow's model can be written as a function of the five variables: S for current value of the underlying asset, K for strike price of the option, T for life to expiration of the option, R for riskless interest rate corresponding to the life of the option, and sigma for variance in the in value of the underlying asset.
Okay. Now, from our own discussion, the underlying asset here are shares. Is that not? Okay, our strike price is otherwise known as our exercise price. It is our X, which also K in this case. Our life to expiration of the option is time to expiration. Riskless interest rate is what we know in this jurisdiction as risk-free interest rate. Okay, variance. Okay, you know what variance is. Okay, is the variability in the return of the plan of the underlying asset, which is the shares. Okay, and the value of a call is based on this formula, and it's very simple by looking at the variables. Okay, the only thing that is now unique is D1 and D2, which is obtained by these formulas. Yours is not to prove the formula, but yours is to annex the formula. And what then you do is to look for the normal distribution, which is the z-score of this ND1 and ND2. But there is a relationship between D1 and D2, and this relationship is what is being shown here, which means when you have your D1, you can automatically obtain D2, and that's what we've seen here. But again, why am I showing you this? I'm showing you this because this model is what is adopted to obtain the fair value of option where we have market condition, And remember yesterday we reiterated that when we have a market condition, we don't re-estimate the likelihood of employees or instrument that will vest. Rather, these have been factoring in the fair value, okay, based on the random distribution and some other things that have been taken into consideration as variables or input into this model. And that is why you don't do what we call true-up approach in the case of the market condition. And we are going to see that today. And I suspect probably one of those exercises where we have market condition is where my brother, Nuruddin, more or less met slight obstacle. But we'll look at it together and we'll use that understanding to do the needful. Okay, thank you very much. Let us commence this class. Now, I'll share this with us, our workbook, and I want somebody to lead us in solving this question. Question 4. I want somebody to read it for us, and so that we can move on from there. Who will lead us? Who will read the question for us?
Okay, I will read question 4. Faramade PLC offered directors an option scheme based on a 3-year period of service. The number of options granted to directors at the inception of the scheme was 10 million. The options were exercisable shortly after the end of the 3rd year. The fair value of the options and estimates of the number of the options expected to vest were, on 1st January 2010, the right expected to vest 8 million and the fair value of the option 3 naira. 31st December 2010, the right expected to vest 7 million and the fair value of option is 3 naira 30 kobo. 31st December 2011, the right expected to vest 8 million, fair value of option 3 naira 70 kobo. 31st December 2012, right expected to vest 8 million and fair value of option 7 naira 40 kobo. Required. Show how the option scheme will affect the financial statements for each of the 3 years.
How can I interpret this question? Who can interpret it? Now, Faramade PLC offered directors an option based on 3-year service period. Okay, the number of options granted to directors at the inception of the scheme was 10 million. Okay, and this is equity settled. And the vesting condition, service condition. Vesting period is 3 years, okay? The option was exercisable shortly after the end of the 3rd year, okay? And the fair value of the option was estimated above, okay? Now, the vesting date will be end of the 3rd year. Okay, number of shares in which option was granted is 10 million. Number of employees in total is 3. Okay, the directors, they just mentioned directors. Let me just say directors, and they've grouped everything together to be 10 million. Okay. Number that vests is a function of what it is at the end of the day. Okay. Right, expected to vest. And as at the end of the year, 8 million vested. Okay, 8 million. Okay, there was nothing like somebody left. Let me just take that off. I don't have that information, but everything is factoring into this. Now, the next thing we need to do is the obtain the fair value. Okay, because this is equity settled, the fair value we need is as at the grant date. The question then is, when is the grant date? When was it granted? The grant date was 1st of January 2010. Okay. And the grant date will be the same as the measurement date for employees. What is the fair value now? Which fair value is relevant for share option or equity settled transaction? Is it the 3 naira? Is it the 3 naira 30 cover? Is it the 3 naira 70 cover? Is it the 7 naira 40 cover? Who can answer that?
Is it 3 naira?
3 naira.
Why is it 3 naira?
Because that is the fair value at the grant date.
Okay, because you are measuring equity. Okay, and that's why we have equity here. Now the question then is, we're in year 1. As at the end of year 1, we estimate the right to vest to be 7 million. Which means as at the end of the year is when you estimate the likely number of shares that will vest. Okay, what you only need at the beginning, which is a grant date, is the fair value of the share option. And therefore, what am I going to do here is I'll make use of 7 million shares. Now, at what price? At 3 naira. And the vesting period is 3 years, which means today is 1/3 of that. And on that premise, what is it? It is the product of the 8 million. Okay, I want to put it somewhere here. Let me create. Let me create something here. Let me create issue of right vest, right expected vest. And this is how I expect you to do it in exam, so that in case for those writing exam, International Diploma in International Financial Reporting, so that you can just link and everything is obtained. Very straightforward. 2010. And 2012. What do we have? We have 7 million. $8 million and 8 million. Okay, now I'll come here. My product is the number, which is 7 million, multiplied by the fair value as at the grant date, which is 3. I have no reason to remeasure the fair value. multiplied by 1/3, because this is the first year in question. Okay, which means this is my answer in year 1. Thereby, I debit my expense, 7 million, and my equity, 7 million. That balance in equity is brought forward in 2011. Now in 2011, what is my year-end estimation? Now, the true up, the word true up means that you estimate the likelihood of, you estimate the likelihood of what will vest. Of this 10 million, you have now estimated that it is 8 million that is likely to vest at the end of the 3rd year, where you are at the end of the 2nd year. And therefore, what happens in this period is that I substitute this for 8 million. And don't forget, it is now year 2. Year 2, which means cumulatively, we should have recognized our expense for 2 years over a 2-year period. And therefore, I copy my formula. I bring it back here. The product now in this case is 8 million. The fair value remains the same, but now it is the 2nd year. And that gives me 60 million. Now, incrementally, the expense is now 9 million. And that's why we have 9 million in the 2nd year. Okay. Okay, now in the final year, the actual amount that vests, which is at the end of the expiration of this vesting period, was 8 million. Therefore, I also come here, 8 million, and I'm in the 3rd year, which means all of those conditions have been met. Cumulatively, I'm supposed to have ascertained my equity as at the end of the year. And in that case, what do I have? Actually, 8 million. And I'm in my 3rd year. All in all, the total amount that we will have accumulated as equity is 24 million. And this 24 million, incrementally over 16 million, will recognize an expense of 8 million. And that is the solution to that, which means in each of those years, 2010 to 2012, we debit our expense regarding employee costs based on share option, and we credit our equity with 7 million in 2010, 9 million in 2011, and 8 million in 2012. Now, Nuruddin, is it the same thing you got? Or Shegun, if you have attempted it? Or Anne, were you able to attempt it?
No, sir.
Why? No time?
No, that I searched for the question. I didn't see it, so I don't know if I was one that did not receive it or that you didn't drop it. I didn't see it. I thought you dropped it on WhatsApp.
It's in the WhatsApp group now. The question has
I didn't see. I have the notes, but I didn't see because I was going to do it immediately. I watched the video.
Okay.
But I didn't see it, so I thought maybe it was.
No problem. Nuruddin, how was it different from what you did? What was the bottleneck?
Okay, this is the one I was talking about, because when I saw the mistake I made is when I saw the right expected to vest, I wrongly assumed that it will be cash settled. I was now thinking maybe I will compute for intrinsic value. That's where I have issue. but I get a clearer understanding now.
Okay, let's look at the fifth question. Who attempted the fifth question?
I'm sorry, I'm not aware we are supposed to attempt the questions. Maybe I wasn't. I'm not aware.
Okay.
I actually attempted the fifth one, but I did not finish it.
Okay, Shegun, can you read the fifth question?
Okay. Okay. ZOE PLC has set up an employee option scheme to motivate its sales team of the 10 key marketing personnel. Each person was offered 100,000 options exercisable at 10 naira, conditional upon the employee remaining with the company during the vesting period of 5 years. The options are then exercisable 3 weeks after the end of the vesting period. This is the second year of the scheme. At the start of this year, 2 marketing personnel suggested that they would be leaving the company during the second year. However, although one did leave, the other recommitted his service to the company and the scheme. The other employee have always been committed to the scheme and stated their intention to stay within the company. The other employees have always been committed to the scheme and stated their intention to stay within the company during the 5-year period of the scheme. Relevant market values are as follows. Grant dates, the share price was 25 naira and the option price was 12 naira. End of year one, share price was 30 naira, option price was 15 naira. End of year two, share price was 45 naira, option price was 24 naira. The option price is the market price of an equivalent marketable option on the relevant dates. Required, show the effect of the scheme on the financial statement of ZOE for second year.
Okay, who can interpret this question? Who can interpret this question?
Okay, let me try. What the question is trying to say is that ZOE PLC has a 10 key marketing personnel, and there was a provision of share-based option of 100,000 options at 10 naira each as at the beginning. Then the vesting period for these options is 5 years. And that is the condition for the option. Then and at the second year of the scheme, there are conditions which they stated, but the first condition is that at the start of the year, 2 marketing personnel is suggested that they would be leaving the company during the second year. I believe this first clause is an estimate of the personnel that were projected to leave the company. But invariably, at the second year, the actual number of personnel that left the company is just only 1 personnel. And the other personnel, which was estimated already, promised to stay to the end of 5th year, where the option will be vested.
Okay. Okay, thank you very much. If you check the question carefully, okay, what we need to understand are very simple. The first thing is that there are 10 key management or marketing personnel involved in this scheme. and each person will be offered 100,000 options exercisable at 10 naira, which is the exercise price or the strike price. Okay, and condition upon the employee remaining with the company during the vesting period of 5 years, which means the vesting period is 5 years and is a service condition. Okay, and the option are then exercisable 3 weeks after. That is just a passive statement, which is not relevant to what we want to do now. And now the question then is, in the second year of the scheme, at the start of the year, which is probably 1st of January 2012, if it's 2012, which is second year, 2 marketing personnel suggested that they will be leaving the company during the second year. What that signifies is that this estimate is considered to have been in existence as at the end of year 1. Because remember, information available to you as at 1st of a year, or let me say year 2, is equivalent to information you had as at 31st December year 1, which means the estimate of likelihood of number of people that will leave out of the 10 marketing personnel are 2 as at end of year 1. But fortunately to the company, during year 2, only 1 person left. And upon leaving, others that may have intention of leaving have now come to a realization that they will no longer leave. Rather, they have passed vote of confidence in the organization that they will continue to work for the organization, which means there is no more person that is expected among these key personnel to leave in the next 4 years, which means our estimates by way of true prop approach have been revalidated and re-estimated at 1 will eventually leave, which means 9 will eventually vest, and that is that. Okay, on that premise, let us see what we'll do in solving the problem. Now, to solve the problem now, because what is to be delivered is a share option, therefore, we'll conclude that this is equity settled. The grant date was the date this was given, and the grant date was given to us, even though we don't know the date, but we'll say beginning of year 1. Okay, measurement date is the same date as the grant date for employees. The fair value that is relevant to us is the grant date fair value. Now, somebody else might have picked 10 naira, which is the exercise price. Remember, the exercise price is just an input towards determining the fair value. That is not the fair value. The fair value is 12 naira for the grant date. Since it's equity, the fair value will not be measured, and therefore I'll put 12 naira. Vesting condition is service condition. Vesting period is 5 years. Vesting date will be end of year 5. End of year 5. Number of shares that option was given to is 100,000. Number of employees 10. Number that vests. Okay, we have no information of it because we are only doing for the second year. We are not going to have the F1 to get to the last year. Now, in this case, what happens? We are told to show the effect of this scheme in our financial statement for the second year. Now, we can't do for second year without knowing the balance in first year. Okay, which means in that situation, I must first obtain my balance in first year. My end value balance is that as at first year, out of the 10, 2 are estimated to have left over a 5 period, which is a vesting period. Therefore, it is 10 minus 2, which means 8 staffs are expected to vest, and each staff is entitled to 100,000 shares. And the fair value of each share, according to the information here, is 12 naira. And we are in the first year out of the 5 years. And that gives us our position. Okay, again, what do? We'll use this as our basis of determining what to do. Okay, those key variables that are subjected to changes or whatever it is are what I'm highlighting in red. Okay. Now, on that premise, what is my product? My product of 10 initially, 2 as at year 1, I expected to have left. Okay, and each one is entitled to 100,000, and the fair value is 12, and we are in the first year out of the 5 years. Okay, on that basis, we have this amount reported as our liability, as our equity position in year 1. Okay, what we needed this for is just to have the opening balance, where we can make comparison with what our estimate was at the end of year 2. Our estimate at the end of year 2 now says that only 1 has left, and all other 9 remain committed to the organization. And we are in the 2nd year, and which is key to us to determine. Therefore, I copy my formula here, and the only variable that is changing is the estimate from 8 to 9, and also cumulatively expense should be recognized for 2 years. And this is it, which means in year 2 alone, what is key is that 2.4 million should have been recognized as our expense in our profit or loss and credit in our equity position. Can you see how simple it is? Nuruddin, are you shocked? I can't hear you. You are muted.
Yes, sir. I got the first one correctly.
Yeah, but the first one is not to be, marked. It's just for you to have opening balance. Okay.
But the mistake I made in the second one is that I wrongly used 2, the estimate for the first one, and still minus the actual. That's the mistake I made.
Yeah, doing that means that it's key to appreciate that you probably missed that question, or because you didn't have understanding of it. Because what they said here is this, let me repeat it. This is the 2nd year of the scheme. At the start of this year, which is at the start of 2nd year, which is equivalent of the position you know as at the end of year 1, 2 marketing personnel suggested that they will be leaving the company during year 2. However, although 1 did leave, the other committed his service to the company and the scheme. And the other employee have always been committed to the scheme and stated their intention to stay within the company during the 5-year period, which means all information, except if they are deceiving you, all the information at your reach has shown that only that one that left will leave. Others have committed. Now, because this is a small sample, we can really say is the best available estimate. But if it's like 1,000 people, it will be reasonable to say yes. And again, remember that these are key personnel, which means you can be able to more or less have more information about their ability to stay over the remaining period or the remaining service period. Does that make sense? Any other question? Now, question 6 I want you to read question 6. I'll just give you an excerpt, and later on, I will allow you guys to go into your breakout session to agree on what is the most appropriate answer to this or approach to solving this. Okay, I want somebody to volunteer to read this. Who will volunteer to read?
Okay, question 6. Okay, if you want to read, please go ahead.
And over to you.
Okay. Question 6. Matilda PLC has singled out the inventory control director for an employee option scheme. He has been offered 3 million options exercisable at 2 naira, conditional upon him remaining with the company for the next 3 years and improving the inventory control by the end of that period. The proportion of the options that vest is dependent upon the inventory days on the last day of the 3 years. The schedule is as follows. Inventory days, proportion vesting. Inventory days, 5. For the day 5, 100%. Inventory day 6, 90%. Inventory day 7, 70%. Inventory day 8, 40%. And for the day 9, 10%. The options also have a vesting criteria related to the market value. They only vest if the share price is above 15 naira on the vesting date. This is the second year of the 3 years. At the start of this year, it was estimated that the inventory days at the end of the 3rd year would be 7. However, during the year, inventory control improved, and at the end of the year, the estimate of the inventory days at the end of the 3rd year was revised to 6. The relevant market data is as follows. Date, share price, and the option price. Grant date. For the share price, we have 18 naira, option price 13 naira. End of year 1, share price 20 naira and option price 16 naira. End of year 2, 25 for share price and 20 for option price. Option price is the option price is the market price of an equivalent marketable option on the relevant date. Required. Show the effect of the scheme on the financial statement of Matilda for the 2nd year instead of Zoe. That's all. You're muted.
Okay, I say thank you. I think the question look interesting. Is it not interesting?
It is.
Okay. I want you guys to proceed to solving or discuss, deliberate on the question, and probably when we come back, we either immediately attempt solving it or we'll attempt to solve it to give you guys more allowance after looking at other aspects of share-based payments, which is the bane of our discussion today. Okay, what's going to happen now is we'll go into our break room discussion, and on that premise, we'll come back to continue the section. Okay. Okay, welcome back to the section, and I believe you guys have had a lot of discussion, and I want you to present your compromise position or your agreement, and in lieu of that, if anyone has a dissenting view, that person is also free to make contribution thereafter. Over to who is representing the group. Thank you very much.
Okay, thank you. The name of the employee that was awarded or granted this option, I mean, the employee is the inventory control director, and he was granted 3 million option exercisable at 2 naira at the vesting date. And we see that this is an equity settled share-based scheme. And it's a performance condition, because it has both the service condition and the performance condition. And in this performance condition, there are 2 levels of performance to be satisfied before he can enjoy this scheme. The first is the market condition, which says that the share price must be above 15 naira on the vesting date. And the second is a non-market condition, which requires that inventory should improve. It requires that the inventory control should improve, and that is the condition for enjoying this share option. Now, we realize that the employee actually satisfied the market condition, because when we look at the from grant date to the end of the second year, there was improvements. I mean, from 18 naira to 25 naira. That shows that he has satisfied the condition. But the only bone of contention is the inventory days. And the inventory days is talking about, the movement of the inventory, how quickly the stock are being converted, to sales. Now, as this third paragraph says, this is the second year of the 3 years. At the start of this year, it was estimated that the inventory days at the end of the third year will be 7. So that means that at the start of the second year, we are estimating that the inventory days will be 7. And based on our agreements, we are saying that this must have been known as at the end of the first year. So we are going to be using the 70% vesting proportion to compute our share option and the corresponding expense. So at the second year, the next sentence is, however, during the year, inventory control improved. And at the end of the year, the estimate of the inventory days at the end of the third year was 6. So that means that our understanding has improved. The estimate is now inventory days of 6 years, and we have to go with the current available information in computing the share option and the corresponding expense. So the second year, we are going to be using 6 inventory days that has a vesting proportion of 90%. So that is just our position.
Okay, which means in year 1, in year 2, what are you going to be using? And year 3, what are you going to be using?
In year 1, we use the 70% vesting proportion. Okay. And in year 2, we use 90% vesting proportion.
Okay. Any other contrary answer? Any contrary answer? Enaro, I think I had you make some commentaries.
No, that is just that was my point. What you said is my point. That for the first year we use the 7 days, which is 70%. For second year we use 6 days. That's what the point I was making. Hello?
Okay. Yeah, I can hear you. Now last time attempt solving it together. Okay, the first thing we need to ask ourselves is, what type of share-based payment transaction is this? What type of share-based payment transaction is this?
Is equity settled share-based payment transaction.
Okay. Equity settled.
Yes.
The next question is, when is the grant date? The grant date is the beginning of year one. Okay, what else?
Please, you're not
You're
sharing,
not sharing your screen. You're working.
Okay, sorry. Can you see it now?
Yes.
Okay, measurement date for employee is same as the grant date. What is the fair value? What's the fair value?
Value is 13 naira.
13 naira. Why is it 13 naira?
Because it says that is the option price. The option price is the market price of an equivalent marketable option on the relevant date. So that is what is there. So the grant date, they say the option price was 13 naira.
Yeah, and because you don't measure equity outside the initial recognition. Okay, vesting condition, that's where we are now. What is our vesting condition? What's our vesting condition?
Okay, I can say we have 3 vesting conditions. Number one is that service condition, that is 3 years service condition.
There's a service condition.
And secondly, improving the inventory control.
That means we have performance condition.
Yes.
And performance condition are in 2 folds. The first performance condition is non-market. Non-market condition is the inventory holding period, Abby?
Yes.
Inventory days. That means the lower the inventory days, the more turnover you make. That's what it means, Abby. And the second condition is market condition. That market condition is increased share price. Abby? Or maintaining share price not to fall below 15 naira. Okay, therefore, does that make sense? Does that make sense to us?
Yes.
Yes.
Okay. Let's continue. What else? Vesting period is 3 years. Vesting date is end of year 3. Number of shares under the option. What's the number? 3 million. What else? Number of employees. It's not relevant in this case. They are just 3. Okay, inventory director, that's 1. Number that vest is a function of what we have here, which is, that's not relevant to us here. Okay, which means I'll just move this forward.
is some information for soccer-related movies. Here's a
Okay. Now, these are the information that exist. We have service condition. We have performance condition. And the performance condition inherent here are the market and non-market conditions. Okay. Now, what do we do? The information here is key. It said, this is the second year of the 3 years. This is the second year of the 3 years. At the start of this year, at the start of the year means 1st of January of second year, which is equivalent of 31st December of first year. It was estimated that the inventory days at the end of the 3rd year will be 7, which means if it will be 7, from the information we have here, it then implies that 70% is what is likely going to vest. Okay, that is number 1. However, during that year, which is year 2, inventory control improved, and at the end of the year, the estimate of the inventory days at the end of the 3rd year was revised to 6, which means as at year 2, it is estimated that the inventory will have improved to 6 days, and 6 days falls under 90 days. Okay, that is that, which means from our true up, with respect to performance non-market condition, it will be 70 as at end of year 1 and 90 as at end of year 2. Now, I had something from your interaction or discussions or the presentation made by Shegun. Shegun said, if you go by this, you find out that the inventory, the share price has continued to increase above this 15 naira. And on that premise, it is likely going to vest, given that we are told that the option also have a vesting criteria related to market value. And this only vests if the share price is above 15 on the vesting date. Now, everything has shown that there is a likelihood that is going to vest because the price has been increasing even from 18 to 25. Which means if you look at the trend, it's more likely that it can never fall below 15, except in extreme situation. But regardless of that fact, before I put my commentaries forward, I'll ask you a simple question. And probably I'll put it to Shegun or to you guys all, because Shegun is representing you. If peradventure, this 18/2025, let me change it to, let me copy it and paste it somewhere else. Let me assume that it started at 18. Now it's gone to 14. Or let me say it's gone to 16. And it's now at 14. What will you do? What will have been your position if this is the new position? Forget this side. This is a new position. What will you do at this level? Will your decision have changed or not? If it has, what will it change to? If it's not, what will you do or what will have been responsible for that? I want an answer. Shegun or anybody.
Okay, if I can just make a very quick comment. At the grant dates, when the share price is 18 naira, because that is the information I have, I will assume that it's going to vest. And I will make my computation based on that share price. The second year, though it had reduced, but it has not reduced beyond the specified amount of 15 naira. So I will still assume that it's going to vest. But as at the end of the second year, which is actually the vesting date, and it had decreased beyond the specified condition, then then it means that the option will not vest because the condition is not met.
Okay, and what will you do? What will be your accounting in year 2?
I don't know the accounting.
No, you have said it will not vest. Therefore, what are you going to do? I remember all of these conditions must be met, which means are you now going to estimate 0 for the director? Who will assist you?
I'm thinking for the second year, when the condition is not met, what will happen is that we are not going to make provision for the options in the second year, but the value we carry in the first year will still be carried forward to the second year.
Even when you have said it will not vest.
So I think there must be a way to derecognize the liability we have recognized before.
That means what you are saying that you recognize?
Yes, we must derecognize the liability.
Okay. I don't think, for me, I don't think we recognize the liability if we are looking at 14 naira. It is still within that range because it was a condition. I don't think that 1 naira difference will be. So I would likely align myself with Bashiru that I will still maintain I'll maintain what I had from year 1, believing that the value of the shares has not deteriorated substantially. But also I would assume that it's going to vest even at 14 naira. But it is when it has deteriorated substantially. If for instance, second year it was like 10 naira. In that case, I can actually recognize the liability. So
okay, I want to say one.
How do you determine substantial?
I want to say one thing. Like we have recognized accumulated liability over 2 years. We have recognized liability over 2 years, and we now realize that we cannot continue to recognize this liability. We have to debit that liability and credit the P or L. So that is what I know to be the accounting entry.
Okay, thank you. Enero is introducing an interesting perspective, and if you could come back, you said because he has not reduced substantially, does that mean because even though it has come to 14, it's likely that it will come back above 15? And 2,
yes. You are saying, okay, I'm with you.
Okay, and 2, what do you mean by substantial? How do you define substantial? How do you quantify substantial so that at what price will you consider it to be substantial that you recognize? Those 2 things, if you can provide clarification, I can now take you to the next course of action.
Okay, so for one, is an estimate. We're in year 2, so the year 2 estimate is 14 naira. So definitely, it's still hovering around that 15 naira.
Okay, at what point you want to change your mind?
continue, I will still believe that. Then, hello?
At what point you want to change your mind, and what will you do in that situation? Which means
Actually, I would see if for instance it goes down to reduced by more than 30% for me, I would think that's substantial. And also, secondly,
if it's 12,
pardon?
If it's not 12, that's substantial.
I think so. Yeah, it will be difficult to come back, even though it can still come back.
Where do you get 30%?
Pardon?
Where do you get 30%, which was your benchmark? Where do you get it from?
No, it is. No, I'm just looking at it that since you're a second year and it's 14 naira, for instance, it can still come back. It can just. That's why I look at it.
12 naira cannot come back.
Well, it will be more difficult for 12 naira to come back.
How do you?
Well, I still support Mr. Enauro, honestly, because the condition of saying is not significant when it was 14.
At what point will it be significant?
When it's reached the vesting period of the third year.
We are talking of the price now. You are saying the 12 and the 14 is not significant. At what point will it be significant? Is it at 13, at 12, at 8, at 1, at 0, or what?
No, at 14, I will not make any provision, but I will not recognize the original liability.
Okay, let me go to it now. And now, if it is 12, 10, or 8, what will you do?
If it gets to that 10 or 8, that in that case, I have a good reason to recognize the expense, yes, and the equity.
Okay, let me
that has been provided for.
Okay, now let us now look at this. And now I want you to read this for me. Treatment of failure to meet vesting condition.
Okay. Treatment of failure to meet vesting, is it not vesting condition?
Meet vesting condition first.
Okay, okay. Service condition, forfeiture. Entity reverses the expense to reflect the best available estimate of the number of equity instruments expected to vest. Service condition. Okay. Performance conditions that are market conditions. No change to accounting. The entity continues to recognize the expense over the remainder of the vesting period.
Okay, sir. And now wait. No. What is the heading here again? Read the heading here.
Performance conditions that are market.
No. I said read the heading.
Okay, treatment of failure to meet vesting conditions.
Now, repeat what you have read here again, and let us discuss it. Yeah.
Okay, it says performance conditions that are market conditions. No change to accounting. The entity continues to recognize the expense over the remainder of the vesting period.
You can tell me what is that and why is that the position taken by the standard?
Okay, I think that what this means is that we still continue to recognize it until the last day of the vesting period. I think that's what this one is saying.
Why do you believe such position was taken by the standard?
Because there's possibility that some of the market condition can improve, can change. So it's an estimate.
It's the 30%, 40%, and all this significant stuff you have mentioned.
Yeah, it doesn't matter now. Those 30% doesn't matter now.
Okay. Why didn't it matter? Can you justify why it doesn't matter? This is for me whether you guys picked one of those critical things I introduced to you yesterday.
So it doesn't matter because they are subject to change. That's what it is. They are
subject to change. That's not the major factor. Yes. there's a factor there. Who can contribute what the factor is? Who can contribute? Who can contribute? Now, let me give you the factor. The factor is this. I told you critically that if it's a market condition, you don't do true-up analysis of trying to re-estimate the number that will vest or not. Why? It's because those ability to meet those conditions have been factored ab initio in the fair value as at the grant date. And that is the reason why I introduced Glasgow's to you guys today, where once fair value is considered at grant date for a market condition, they factor in all of those macroeconomic variables that will likely impact the share price up to the vesting date, which means any movement in the share price, whether it is above the share price target or below the target or to zero, does not matter in the recognition, which means you still continue to do it as if nothing has happened up to the vesting date. And that is the position that the standard has taken. This is because the fair value of the option has factored in all market conditions and its variability with respect to this volatility. Remember, this variance here has considered market volatility. Another name for this variance is what we call market volatility, which, if you want to have more knowledge on it, it could be historical volatility, or it could be more or less implicit or implied volatility. Okay, and that is that, which means this volatility has been factored in, you can see, in the measurement of the fair value, which is the value of the call option that is given to the employees. And therefore, whether the price is going up or coming down, it doesn't matter in the process of accounting for it, which means your focus will now be on the performance, not market condition, and not market condition, because the market condition has been taken care of in the measurement of this fair value of the option. Does that make sense now? Which means whether I'm playing with number up and down, it doesn't matter. My focus will now be on performance condition. Therefore, I'll go back to my performance condition. But before then, I want you to finish others. And now, can you finish others? Treatment of failure to meet vesting condition. Now we are now at performance condition with non-market condition. Go ahead, and now. Can you unmute?
Sorry, I've done that. Performance conditions with non-market conditions. For future, entity reverses the expense to reflect the best available estimate of the number of equity instruments expected to vest. Okay. So that is the next one.
Yes.
Treatment of failure to meet non-vesting condition. Neither the entity nor the counterparty can choose whether the condition is met. No change to accounting. The entity continues to recognize the expense over the remainder of the vesting period. Entity and the counterparty can choose whether the condition is met. Cancellation. The entity recognizes immediately the amount of the expense that would otherwise have been recognized. over the remainder of the vesting period.
Thank you very much. Now, let's go back to our question. Now, what do we need to do at this point? Is that the market condition does not matter to us. This is not of essence to us, which means in this case, I'm not bothered. Where's my annotation? In this case, I'm not bothered with this share price movement. I'm not bothered with this. Dig and say now. That is what is key to us. Therefore, what do we do? End of year one, we have an estimate based on the fact that it's going to be 7 days. Inventory days will be 7 because this was the estimate made as at 1st of January year 2, which is also equivalent of our reporting date in year 1, 31st December year 1, which means in that case, 70% is expected to vest. I'll come here and say 70%. 70% of what? Of the 3 million. Okay, and that will give me the number of shares. And I can multiply this by the fair value as at the grant date, which is 13. And thereafter, I multiply it by, this is the first year out of the 3 years. And that should give me my answer. Therefore, what is key here is the 70% here. And this 70% was obtained on the basis of the number of inventory days. Also, I'm apportioning it first year out of the 3 years has now been recognized. Okay, in that case, I can come here, the product of 70% of 3 million and the fair value of the option at the grant date. Don't misconstrue that with the fair value of the, what's it called? The fair value of the share price, no. And next is 1/3 years, which is the service period. And I've also told you that in every performance condition, there is a service condition. What is missing? Okay, so that's 9.1. Okay, now year 2, year 1, I only need it for the opening balance because the accounting entry expected from me is year 2. Therefore, in year 2, we have estimated that there is an improvement, and this will reduce inventory days, holding days to 6 days. And 6 days is equivalent to 90 days vesting proportion. Therefore, I'll come here and say 90 days of the 3 million. The fair value will still remain unchanged, and this is 2. And therefore, I copy my formula. And what is different there? I'm picking from the cell where I have 90 days. The fair value will not change, regardless of meeting or not meeting the market condition. And I'm computing for the second year. And I give you 23 million. Therefore, the incremental amount is 40.3, which is what I have here. Okay. And that provides me my solution. Any question? Can you see how straightforward the solution is? Any question?
You just meant we should not confuse the option price with the share price.
Yes.
Maybe when I listen to the first video, maybe I'll get the reason why the option price is
yesterday. Yeah.
Yes, I'll
and
look at it.
Why you should not confuse it is this. Let me share this to you again, in case you've not able to have time to watch the first video. Okay, this is it. Have you seen this? Have you seen where the stock price is? This is the share price. It's just an input, okay? And the fair value of the option requires these 5 inputs. And that's what you can see here. Any other question? Okay, therefore we can continue with our discussion and we'll move to modification. We'll move to modification. Now, it's critical for us to have better appreciation of this. Okay, now modification of a share-based payment scheme or transaction implies that you are more or less either increasing or reducing the value of the scheme to your shareholders, to your employees. And this is based on the fact that market factors might affect your share price, so that your share price might have grown higher or might have reduced lower, or the ability of the company to meet up with those future payments or future delivery of shares might be affected. And on that premise, it is better for the company to more or less modify that scheme. Therefore, you could conclude that an entity might decide to modify the share option, either by repricing the option itself or by changing them from cash settled to equity settled, or from equity settled to cash settled, or where choice is given to the employee to decide whether it will be equity settled or cash settled at the vesting date. And in this slide, what then happened is that how do we account for such a modification is what is critical to us. Okay, how do you account for the modification is to more or less split it into 2. The first is that assume that the existing scheme continue to operate, and the increase that may affect the scheme, which is additional cost to the company, will assume to be a separate scheme that will begin on its own. I'm going to break it down as we move on. And take note, modification might bring about increase in value to the employee, which is increase in cost to the employer. The modification can also bring about decrease in value to employee, which is a reduction in the cost to the employer. But the conclusion of the standard is this. If the modification will bring about increase in cost to employer, such modification should be recognized and treated in accordance with what I've said earlier. But if the modification or repricing will bring about decrease in the cost to the employer, therefore, based on prudence concept, this should be ignored as if there was no modification. And you continue to account for it as if there was no modification. And that is the position of the standard. And we're going to look at this one by one. Now, I want somebody to read this, and I've also put up a diagram to be able to explain what it means with modification. Can somebody read this?
Modifications. The entity recognizes as a minimum the services received measured at the grant date, even if modification is beneficial for the entity. 1. Effect of modifications that increase the total fair value of the share-based payment arrangement. Incremental fair value recognized over the remaining revised vesting period. Original fair value recognized over the remaining original vesting period. 2. Effect of modifications that reduce the fair value of the equity instrument granted shall not be taken into account, and an entity shall continue to measure the amount recognized for services received as consideration for the equity instruments based on the grant date fair value of the equity instruments granted.
Now, what it then means in this case from this diagram is that this is the first arrangement on the grant date. In between that date, there was a change. And what we are saying is that from the point there's a change, you now have two instruments in one, provided that that change will bring about increase in the value to the employee and increase in the cost to the employer. Therefore, the first one will be the original fair value, which will be recognized over the normal remaining life, while the other one, which is incremental, will not be recognized from that point for the other extended period. And we are going to see that as time moves on. Okay, the next thing we also look at before we look at illustration is this. Now, if the modification is such that it reduces the value, what you should do is to what? Ignore the modification as if there was no modification for the purpose of accounting. And this is in tandem with prudence rules so that employers will not be using such to distort the flow of the financial statements. Now, on that premise, I'm going to give you a question that we will solve collectively. Any other question before we move on? Okay, in the answers of that, let me share my working note. Okay, I think we have to use the Excel. Where's my Excel? Modification to share-based payment. Okay, I think, let me enlarge it. Okay, can somebody read this?
Okay, example, modification. Can I go ahead?
Yes, go ahead.
Okay, modification, change in exercise price. At the beginning of year one, Celloco grants 100 shares option to each of its 500 employees. Each grant is conditional upon the employee remaining in service over the next 3 years. Celloco estimates that the fair value of each option is $15. On the basis of weighted average probability, Celloco estimates that 100 employees will leave during the 3-year period, and therefore forfeit their rights to the share options. Suppose that 40 employees leave during year one. Also suppose that by the end of year one, Celloco's share price has dropped, and the company modifies the options by repricing them. The repriced share options vest at the end of year three. Celloco estimates that a further 70 employees will leave during year 2 and 3, and hence the total expected employee departures over the 3 years vesting period is 110 employees. During year 2, a further 35 employees leave, and Celloco estimates that a further 30 employees will leave during year 3. To bring the total expected employee departures over the 3 years vesting period to 105 employees. During year 3, a total of 28 employees leave, and hence a total of 103 employees ceased employment during the vesting period. For the remaining 397 employees, the share options vested at the end of year 3. Celloco estimates that at the date of modification, the fair value of each of the original share options granted, that is, immediately before taking into account the repricing, is $5, and that the fair value of each repriced share option is $8.
Okay, who can interpret that question? Who can interpret it? Who can interpret the question? I'll wait you guys. Okay, now to attempt solving this question, as usual, we need to answer these following questions. Okay, the first thing is to ask ourselves, what type of share-based payment is this? It's equity settled. Okay, I find that we have done more of equity settled because that is what accounts for much more of such transaction than cash. Grant date is beginning of year one. Okay, measurement date is same date. Fair value, initial fair value is $15. Okay. For the option, I'll qualify it and say initial or original fair value for the option. Okay.
We can't see your screen. If peradventure you share your workbook.
Okay, sorry. Okay. Now the vesting condition. I also have the incremental fair value, new fair value of the option, or I'll call it revised fair value of the option was said to be 8. The vesting condition, the service condition. Vesting period originally is 3 years. Vesting date is end of year 3. Number of shares option is 100. Number of employees is 500. Okay, now in year 1, there's no issue. Therefore, in year 1, I can easily determine what it is. Year 1, we estimated that 110, even though 110 is likely to depart. And how do we get about that? We said, suppose that 40 employees leave in year 1. Also, suppose that at the end of year 1, the company share price has dropped and the company modified the share option by repricing them. Okay, and the repriced share option vests at the end of year 3. The company estimates that a further 70 employees will leave during year 2 and year 3. That is how we get our 110. And therefore, I'll come here and say, out of the 500, 40 has left, and we estimate that 70 in addition will leave. And that will give us the number of staff. And that multiplied by each staff will go with 100 shares. And the fair value originally was 5. And we are in the first of the 3rd year. And this should give us our value. All things being equal, what do we have? The product of 500 employees minus 40 that have left, minus 70 estimated to leave further. Okay, multiply by 100 shares, multiply by the fair value, which is 5 or 15? Sorry, the fair value is 15. It's 15, sorry. I'll change it. I'll multiply by 1/3. Okay, this is 15. Okay, I'm coming back to this 8. We'll discuss that. That's 195. That comes as our opening balance. Now, the original scheme continues to operate, and it operates on the premise that as at the year end, $40 has gone before. Now, when you check the question, say during year 2, a further 35 left, which means apart from 40, 35 left. And we estimated that further 30 will leave. Okay, that gives us the number of staff. Multiply by 100, multiply by 15, not 5. And we are in the 2nd year, which is 2/3. Okay, this is 15, not 5. Okay, let me put this in red. I love this in red. Okay. Now, the product of that, let me copy it from here. I'll bring it here and I'll tell you why. Now I'm removing 35 and another 30. The fair value remains the same at 15, and I'm changing this to 2 years. Okay, now if you have this, this is 395, but there's a statement here. Who can interpret this statement? This last statement here, let me highlight it. Okay, can somebody, this highlighter is not trying to, okay. Can somebody read this statement here?
Okay. Selco estimates that at the date of modification, the fair value of each of the original share options granted, i.e., immediately before taking into account the repricing, is $5, and that the fair value of each repriced share option is $8.
Now, let me now show you what I was trying to do here. Okay. Prior to the modification, the fair value of each of the original option has fallen to. Therefore, I'll come down here to say fair value original now reduced to. Reduced because in the market, there's a downturn such that the share price of that company has fallen. And this has reduced to, what do they have there?
$5.
It has reduced to $5. But the revised option that is now to be issued is now 8 in order to compensate, which means there will be additional cost to the employer. And that is that. Therefore, the difference between these two is what matters to us now. Okay. Now, which means incremental is the difference between the revised, which is 8, and the reduced value of the original, which is 5. And therefore, the incremental here will be to use the same information as we have it here. But the difference in that information now, the difference in that information is the additional cost to the employer is the difference between 8 naira and 5 naira. And therefore, I'll come here. Instead of 15 naira, that will be the difference between 8 naira and 5 naira, which is an additional or incremental fair value of the option price. And therefore, I'll come here. And that is it, which means the additional costs created by such modification have to impact the profit or loss of the entity as at that date, which is a $3 or dollar as the case may be. Okay. Now, what will be the value? You find the product of all of those values. And remember that 1 year has gone before the repricing took place. It means this will only be for 2 years. And we are in the first year of those 2 years, which means what you are trying to do is like, apart from the original they have, you are giving them additional option again. You understand? And that will only last for the remaining 2 years. And that's what we need to do here. And therefore, what do? You have it for 2 years. Now, let me put my formula in. I copy this. My Excel model is acting up. It's not allowing me to click, right? Okay. Now I can copy this formula and modify it. What am I modifying there? The same thing I have here. Okay. Now I'm using the price, not the 15. I'm not using the difference between the 8 and the 5, which is the incremental cost. And now I'm doing for the second year out of the first year. And that will give me this. Invariably, what I have is this, which means this is the original and this is the incremental. The total represents my liability. But if it will have brought about reduced cost, we'll ignore this incremental. That is what modification requirement is all about. And at the end of the day, this is my expense for the second year. And this balance is what I brought forward to the third year. In the third year, also, what do? What is information in the third year? In the third year, 28 left, which means by third year, we've known the actual that vests. Therefore, 28 left. And we are in year 3. And we recognize all of it all. And again, I bring it down. And what am I changing there? I'm in period 3 of 3. And it's no longer 30 as estimated, but 28 left. And that is it. Okay, on that premise, I'll also copy this. The only thing I'm changing here is the 28 that left. And this is now 2/2 because from the date they repriced, it was 2 years to go. That is why the incremental cost will be apportioned over the remaining 2 years, while the original one will be spread over the original period. And that is what we've done here. Okay. Now, what is that? I'll copy this. And it's no longer 30, it's 28. and this is 2/2. At the end of the day, I have this position, which means at the end of the day, what we need to do is what we have done now. That is the incrementer, which we have here. Let me put it in green color. So let me just leave it in the red and put it. The incrementer that you have here is as a result of the difference between the repriced fair value and the reduced fair value of the original option. And that is it. Okay. And that will be for the remaining period, which is for 2 years. I will take 1/2 for the first part of the year, and we'll take 2/2 of the later part of the year. You find out that this did not change. The original schemes did not change. Let me just bring it here. Original scheme. Let me leave it in year 1. Did not change, which means this is as if there was nothing that has happened. And that is the issue there. The only incrementer is this and this. And what is changing there is that our option price, original option price, will be substituted with the incremental difference in the revised option price compared to the reduced price. And that is that. And we are going to apportion it for the remaining period left, which is 2 years, 1/2 for the first part of the 2 years, and 2/2 cumulative expense for the later parts. Any question on this? Any question on this?
Yes, sir. It's not a form of question, but a clarification.
Yeah.
I believe what we are modifying is the original share options given to the employees, right?
Yes.
But I want to know the conditions that can actually reduce the grant price, as in the grant fair value that we agreed originally at the grant date. I want to know those factors that can bring it downward to like $5, as this question implies, which were repriced to be $8. That is my observation.
Now, can you read this out for me? What I just pasted there. Example of what can bring it to the pricing.
For example.
Okay.
For example, if there is a downturn in the equity markets, an entity may modify its share options by reducing the exercise price. Reducing the exercise price would cause the fair value of the share-based payments to increase. IFRS 2 requires that this increase in value must be recognized over the remaining period until the option vests.
Okay. Now, do you understand that statement?
I understand the statement, but I have issue.
Yeah.
The issue I have is to the employer. The issue I have is to the employer, because the fair value of employers' share price has reduced already, and this interpretation is still increasing the expense to the employer.
Yes. Okay. Now, do you know what has happened?
Yes.
Employee that you are incentivizing before, when your share price was 20 naira, that you promised to sell it for them at 5 naira, are happy, Abby? A year
Yes.
down the line, your share price has come to 7 naira from 20 naira.
Yes.
And you are telling them to pay 5 naira. Would they be incentivized?
No.
Therefore, to incentivize them, what will you do? You will reduce the excise price from 5 naira to probably 1 naira.
Exactly.
So that they can still maintain that level. Is that not bringing additional cost to you?
Yes.
That is it.
Okay, understand.
Okay, now let's look at another question. I want somebody to read out the question. Who will read out the question?
Okay. 171. Example, cancellation and reissuance. On 1st January 2021, Piper Co. made an award of 3,000 share option to each of its 1,000 employees. The employees had to remain in employment until 31st December 2023 in order to be entitled to the share options. At the date of the award and at 31st December 2021, management estimated that 100 employees would leave the company before the vesting date. Piper Co. accounted for the option correctly in its financial statements for the year ended 31st December 2021. The fair value of each option on 1st January 2021 was $5. The share price of Piper Co. fell substantially during 2021. On 1st January 2022, the fair value of the share option had fallen to $1 each, and 975 of the employees who were awarded option remain in the company employ. During the year ended 31st December 2022, 35 of those employees left, and the company estimated that a further 40 would leave in the year to 31st December 2023. Required. Discuss with suitable calculation the accounting treatment of the share option in Piper Co. financial statement for the year ended 31st December 2022 if on January 2022. A. The original option were cancelled and $4 million is paid to employees as compensation. B. Piper Co.'s management cancelled the share option and replaced them with new share options, vesting on 31st December 20x4. The fair value of each replacement option on 1st January 20x2 being $7. No compensation was paid. The company estimates that a further 40 employees will leave during the year to 31st December 20x4.
Okay. Who can interpret that question? Who can interpret the question? Who will interpret the question for us?
Okay, let me try. Okay, the question, the company Piper Co is the one awarding the share options to 1,000 employees. Okay, the vesting date for these share options is 31st December 20x1. And the vesting condition is that the employees will remain in the employment for, I'm trying to look at the place where I saw. Okay, I couldn't find it, but the condition is that the employee will remain in the employment until the vesting date. Okay. Well, some of the dynamics in this question is that in the second year, the share option of the entity dropped to $1 from $5. And in the second year, which made the employer to cancel the original option for those ones that are vesting and replace it with a cash payment of $4 million as compensation to the employee. And later, they reprice the options to $7. That is what I can say on the questions.
Okay, if I'm just to add one or two things to what he had said, I think he had properly interpreted the first aspects of the question. But in terms of the requirement of the question, the first one is the A part is cancellation of the share option agreement with a compensation of $4 million to every of the staff that are entitled to it. While the second is repricing of the share option, which had fallen to $1, which was later repriced to $7. And I'm seeing this as being an additional value to the company, which, as you explained initially, that's the standard forbids recognizing any additional value to the company. We just treat it as if nothing has happened.
Exactly.
Are you sure that's what has happened? I'm asking.
Okay, I think it's just the opposite.
Who else will support us? Contribution from others? And now, Anne.
I think the first one, I do understand that first part. That of the other one that was converted to cash. So there's a forfeiture. I think that one is a little bit straightforward. The treatment will be reversed. That's the A part. But the B part is what I'm trying to digest. What is all about? I'm still digesting it.
This indication was audience to the new commander of Nigeria Airport, now one station in Jos, market.
Who else? And
From the question, I can see that Piper Co awarded the 3,000 share option to 1,000 employees upon the vesting condition that they will remain in service in employment for 3 years. I deduced that from 20x1 to 20x3, which is 3 years. And also, there was an estimation. There was an information that the share price reduced. I can't see the question again. Yeah.
okay, that the share price reduced to what?
I can't see the question. I think I'm actually using it to answer
Okay.
the question.
Okay, I'm going to switch it up for you now. Can you see it?
Yeah, but it's smaller. Okay. 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 The price reduced from $5 to $1. Then even after we got the information that some employees had left, I'm coming. Some employees.
Okay. Wrap it up so that we can look at it together.
Okay. That after some employees had left, that we now have 975 employees. That by 20x2 we had additional 35 employees, which is an estimation, and also 40 will also be living at 20x3. So there was an estimation that 35 and 40 will be living at 20x and 20x3 respectively. So that's what I can deduce from the information.
Okay, thank you very much. Can somebody read the question again, and we'll pick the fact of that question and we'll try to explain the solution.
Okay, can I read again?
Yes.
Okay, cancellation and reissuance. On 1st January 20x1, Piper Co. made an award of 3,000 share options to each of its 1,000 employees. The employees had to remain in employment until 31st December 20x3 in order to be entitled to the share options. At the date of the award and at 31st December 20x1, management estimated that 100 employees would leave the company before the vesting date. Piper Co. accounted for the option correctly in its financial statement for the year ended 31st December 20x1. The fair value of the option on 1st January 20x1 was $5. The share price of Piper Co. fell substantially during 20x1. On 1st January 20x2, the fair value of the share option had fallen to $1 each. And 975 of the employees who were awarded options remain in the company's employ. During the year ended 31st December 2022, 35 of those employees left, and the company estimated that a further 40 would leave in the year to 31st December 2023. Required. Discuss with suitable calculation the accounting treatment of the share options and Piper Co. financial statement for the year ended 31st December 20x2. If on January 20x2, if the original options were cancelled and $4 million is paid to employees as compensation. B.
Well, let's leave B.
Okay.
A is still fresh in our memory. What it means is this: the share price of the company has fallen such that the value of the option to the employees, if it vests, has fallen to $1, which means the cost to the organization has reduced significantly. Therefore, what they have decided to do is to cancel. Okay. And when they cancel, they issue those shares to them, but the shares have suffered loss in the market. But in lieu of that, they are also going to pay them compensation of $4 million in addition. The question then is, how do we account for this? This is not a modification. This is a pure cancellation. And cancellation comes with compensation. How are we told to treat cancellation? Let us go back to what we discussed here. Can somebody read the treatment of cancellation of share-based payments?
Cancellation of share-based payment transaction. Treat as an acceleration of vesting and recognize immediately the amount that otherwise would have been recognized for the service received over the remainder of the vesting period.
Which means at this point of cancellation, you should immediately recognize the other portion that should have been recognized over the remaining time. You recognize it immediately now. And how do we do that? Let me switch back. Look at what we did. The original options were canceled. Forget about compensation for now. How do we treat it? Before cancellation, year one, we have treated it based on our expectation. In year one, we expect 3,000 options to be granted each, and we have 1,000 employees. And as at that year one, we are told that 100 employees will leave before the vesting date or through that period. It then means that out of 1,000, it is only 900 people that will benefit. How do you arrive at 900? 900 is arrived at by deducting 100 from 1,000. And the 900 will be entitled to 3,000 each at the fair value as at the grant date. If you remember, this is the fair value as at the grant date. Now, and we are in year one, we take 1/3 of it, because remember, the service condition is for 3 years, and we are in the first year, and that is how we arrive at 4.5. Now, this 4.5 is our balance brought forward to year two. Now, it is in year two that cancellation took place. Now, in year two, when cancellation took place, we should more or less ask ourselves, what is the expectation? The expectation has not changed from that 100, which means it's also 900 people that we are still considering will be existing till end of year 3. Now, that 900 multiplied by 5 times 3,000 will give us for the whole 3 years, which means if you multiply 3 over 3. Now, the whole 3 years, we are to immediately recognize it now, but we have already recognized 4.5 out of it before. It is a difference between that whole 3 years and 4.5, which represent the one for year 2 and year 3, that we are going to accelerate its recognition in year 2, which is the year of cancellation. That's why here you find out that what we have here as 13.5 is the 900 multiplied by 3,000 and the 5 for the whole 3 years. And we are now told that we have already recognized 4.5 before out of this 13.5. The balance, which we are going to accelerate and recognize as a debit, which is an expense in my profit or loss, is 9 million. And equity is this. Now, this is what you do, whether you compensate or you are not compensate. Now, which is the entry we have passed. But again, there was a compensation we paid, which is additional cash expense. And that, based on normal accounting entries, that instead of you to treat it as cash expense, first, you are going to treat it as purchase of equity, which means out of the 4.5 that you have recognized in equity before, 4 million is being purchased back. And of that 4 million, what was the fair value of the option? It has fallen to $1, which means $1 worth of shares is what was eventually purchased back, which is $1 times how many shares vest? 900 people and 3,000 per person. This $1 is the vested, or I won't call it vested, is the fair value of the option at cancellation. And in that situation, you multiply that, you get 2.7. But what you have paid them for that cancellation is 4 million. What you have simply done is that you have paid them additional 1.3 million as an additional expense or contribution they've made, which is the balancing figure here. 2.7 is the value of the option that was canceled, but 4 million is what you paid them. It then means 1.3 million is additional cost to you as an employer in order to compensate your employee. And that is the treatment. Now, that is very straightforward. But again, if you look at here, we are now giving information as at year 3 and year 2 that 975 of the employees were awarded options remained in the company, which means instead of using 900, which is my estimation, I might use 975, which is the actual. But the problem with this is that the standard does not tell us whether, or the standard did not mandate us to use estimated or actual when a cancellation takes place. That is why you find out that in EY, Ernst & Young manual, what they have concluded is that they interpreted it that you might decide to use the actual number left as at the point of cancellation, or you might decide to go with what was estimated. But again, regardless of what you have chosen, your disclosure requirement will exonerate you in your accounting for it. But again, that position still reflects what we have discussed with respect to cancellation. That once you have canceled, whether you pay compensation or not, you must accelerate the recognition of the remaining expense over the vesting period immediately in the year in which that cancellation has taken place. Now, that is for A. Any question with respect to that A? Any question with respect to the A? Nuruddin.
Yes, sir. It was fairly presented. I get the explanation clearly.
Okay, can you go with information B? If A is not done, what if they cancel and they reissue another, what's it called? They reissue another, what's it called? Option. Yeah, read B now.
B, Piper Cost Management cancel the share option and replace them with new share options vesting on 31st December 20x4. The fair value of each replacement option on 1st January 20x2 being $7. No compensation was paid. The company estimates that a further 40 employees will leave during the year to 31st December 20x4.
Okay. Now, before you do that, I will now share something with you for us to look at before we attempt solving it. What is the treatment where you cancel and you immediately replace with a new scheme? Can you read that?
Cancellation and replacement with a new share-based payment scheme. Where new instruments are granted. 1. Treatment as a modification of the original grant or as a cancellation with an issuance of new instruments depending on the facts and circumstances. 2. If the grants of the new instruments are treated as replacement awards, the incremental value, fair value granted is the difference between the fair value of the replacement instruments and of the old instruments, both measured at the date of the replacements.
Now, what we are simply saying is that you will treat the cancellation as a modification to the original, what's it called? The original option granted. Okay, now look at what we did here earlier in my Excel. Okay, where we did modification, is either you treat it in this light, okay, or you treat it as pure cancellation and you end the cancellation treatment and you start a new one. Both are likely going to give you the same results. But how are we going to treat it? Let us look at the solution now. Now, what we're going to do here is that the original option cancel and replace new one. The replacement share option are treated as modification of the original parts, which is the first option I mentioned earlier. Now, therefore, the essence of the fair value of the new option over the fair value of the cancel option is charged to profit or loss over the new vesting period. Now, remember that before now, the value was $1, has fallen to $1. But now we have canceled it and reissued another one with a value of $7. And that one is extended to 20x4, which means as at end of year 1 or beginning of year 2, which remains 2 years to go, we have now extended it to 3 years because we have reissued new one. Therefore, the difference between this 7 and 1 is the incremental that we have here. This 6 is the incremental. That's the incremental effect of the new option. I think I didn't write it well. or cost of the new option. Okay, now the original fair value will continue to be charged over the remaining vesting period, which is consistent with what we have done earlier in the modification. Okay, and let's look at it. The charge recognized in profit or loss in second year, which is 20x2, is as follows. Remember this 4.5 we have gotten before, and now we have 13.76. How do you arrive at this 13.76? If you remember, this was the original. The original has 975 left as at the time we canceled. 35 is expected to go in year 2. 40 is expected to go in year 3. If not for the modification, there wouldn't have been this 40 in year 4 because there was a modification in year 4. If you can't remember, see it here. 35 in year 2, and in year 3, 40 is expected to leave. In year 4, which is now the extended period, another 40 is expected to leave. That is where we got that from. Okay. Now, that shows that we have 860 left. Now, 860 is expected to be existing as at the time it vests, and each one is entitled to 3,000. I remember our original fair value of the option was 5, and we are in the second year of the third year. And therefore, that is key to know. But remember, we have the replaced option. This replace is also known as the new or incremental option we had. This 860 is what flows from our estimate here. We don't need to repeat it. This 3,000 is the same 3,000 per person. But now, remember, the incremental is $6. This is synonymous to the $3 we did in the other modified one we did earlier. Remember this modified, difference between 8 and 5, which is the $3. That is the same thing we are doing here, which is the difference between the 7 and the $1. Remember, difference between the repriced option value and the reduced option value, which is the 6. And that's what we have here. But remember that there are now 3 years to go from this modified because it has been extended by 1 year. Okay, how do you know it's extended by 1 year? You see it from this information. Originally, this scheme is supposed to end in 20x3. But by way of cancellation and replacement, there's a new option that will vest in 20x, which means 3 years start to count from end of year 2. And as at end of year 2, we now have 1 year now passed out of the 3 years. And that is how we obtain this amount. The sum of this is what gives us 13.76. This 13.76 is the same thing similar to what we did under our Excel here, which is this aspect here and this aspect here, adding the incremental effect of modification to the original scheme. And that is what we've done also in this case. Okay, now doing that gives us this. The difference between these is what we accelerate. Accelerated expense. Expense, which is charged to your profit or loss, 9.27. And at that point in time, that is how you recognize a debit to your profit or loss and a credit to your equity. Any question on that? Any question on that? Any question on this suggested solution? Any question or contributions? Okay, if there's no question.
Sorry, there is question.
Yeah.
Okay. I am looking at it from another perspective.
Yeah.
If, for example, the share price of an entity, maybe it's the original fair value, the original option price is 15 naira per share, and it's crashed to say 8 naira per share. And by the time they are repriced, they priced downward to like 5 naira per share. What will be the interpretation of that?
Repeat your statement.
What I'm saying is that, for example, the original option price is 15 naira per share.
Okay.
Okay. And there was an economic downturn which made the entity share to crash to $8, 8 naira per share from 15 naira per share. Invariably, they did cancellation, and by the time they now repriced lower than the price that the share price fall to. For example, it fall from 15 to 8 naira. Now, by the time they're repriced at 5 naira. How are we going to undo that?
Okay. Do you know that the word cancellation means that you've shortened the vesting period of that shares so that they can have access to it, and you are issuing new ones.
Okay.
Have it at the back of your mind. That, which means they will not have rendered future service before you give them that shares immediately for them to go with. That's what we're talking about. That's why you immediately recognize such a cancellation as an expense.
Okay.
And anyone you are issuing newly is like a new scheme as a whole. That's what we are saying there.
Okay. Does that interpret that when they were reissuing, it can be reissued below what it has fallen within?
No, it has nothing to do with the price of the first one. It now depends on the new value. Remember, we showed valuation yesterday.
Yes.
The value of an option is influenced by 5 factors or 5 variables. 2 variables impact the intrinsic value, which are the actual stock price as at the time it is granted and the exercise price. 3 variables impact the time value. The 3 variables are the volatility, the time to expiration, and the risk-free rates. Therefore, all of these factors or variables are what determines what the option value is. Do you get what I'm saying now? Therefore, it's not issue of you working to what is it higher than before or lower than before. Remember, the one originally done has been cancelled out and has been deemed to have vested immediately. That's why you are accelerating the expense into your profit or loss.
Okay.
Yeah, and that is a position there.
All right, thank you.
Okay, now let's go back to this. Remember, we discussed this earlier yesterday. This issue of where settlement as an alternative. If the issuer has a choice, the issuer is likely to treat it as equity settled based on past experience and policy. Otherwise, if their policy has changed so that they prefer to pay cash in lieu, they will treat it as a cash settle. But from the angle of the holder, which is the employee, you treat it as a compound instrument. And for a compound instrument, you first of all determine the liability component, and we are going to see that being the fair value of the more or less the alternative share that will have been granted, and the price of the cash set, the former equity. You are going to see that as we move on. That will be used to determine the liability component. Why the difference between that and what it's being priced will serve as the residual, which will be the equity component. And to discuss that further, I want somebody to read this out and we will discuss it and use practical illustration to explain it. Can somebody read this out and discuss it extensively?
Okay. Can I?
Yeah, over to you.
Okay. Share-based payment with the choice of settlement. Entity has the choice. If the entity has the choice of whether to settle the share-based payment in cash or by issuing shares, the accounting treatment depends on whether there is a present obligation to settle the transaction in cash. Is there a present obligation to settle in cash? If yes, treat as cash settled share-based payment transaction, and if no, treat as equity settled share-based payment transaction. A present obligation exists if the entity has a stated policy of settling such transactions in cash or past practice of settling in cash, because this creates an expectation and so a constructive obligation to settle future such transaction in cash. Counterpart has the choice. If instead the counterpart, e.g. employee or supplier, has the right to choose whether the share-based payment is settled in cash or shares, the entity has granted a compound financial instrument, IFRS 2, paragraph 35. The entity has issued a compound financial instrument. We have debt component and equity component. For debt component, we have as for cash settled transaction, then for equity component, measured as the residual fair value at grant date. Okay. Once the debt and equity components have been established, the accounting for each follows that for a cash settled scheme or an equity settled scheme, respectively. Illustration. On 1st October 2020.
Before the illustration, okay. Remember what I said there earlier, which is where it is the employee that has the option, you need to treat it much more as compound instrument. And in that case, compound instrument has to be separated into the debt component and equity components. Okay, the debt component is measured in line with the cash settled. The equity component is the residual. Now, what you are seeing here as equity component is the residual. And what is the residual? The residual is the difference between the fair value of the share alternative at grant date and the fair value of the cash alternative at grant date. Now, to look at that specifically, that's why we are looking at this illustration. Where you can proceed to read the illustration.
Okay. Illustration. On 1st October 20X2, Sadler granted one of its directors the right to choose either 24,000 shares in Sadler or 20,000 phantom shares, which is a cash payment equal to the value of 20,000 shares. This right is conditional on the director remaining in employment for 3 years from the grant date. The company estimates that the fair value of the share alternative at the grant date is $4.5 per share. Sadler's market share price was $5.20 per share on 1st of October 2022 and $6.10 on 30 September 2023. Required. Explain the accounting treatment of the above transaction for the year ended that started September 2023.
Now, it's so key. Therefore, now let me show you how we solve this problem. What is key there is that is either they take delivery of these shares or they take cash with respect to notional amount of shares, which we call the phantom shares, equivalent to 20,000 at the price. Okay, this right is conditioned upon directors remaining in 3 years, which means this is the service condition, and the vesting period is 3 years. The grant date is 1st of October 2022. Now, the company estimates the fair value of the share alternative. If they are to go for the shares, the fair value is 450, which is the option. But if they are to go for the cash settlement, which is based on these phantom shares, each share price goes for $5.20 as at the grant date, and as at the reporting date a year after goes for $6.10. Now the question is, explain the accounting treatment of the above transaction for the year ended 30th September 2023. Now, I want you to understand this. Can you read this further so that I can explain it further?
Okay, solution. The right granted to the director represents a share-based payment with a choice of settlement where the counterparty has the choice. In substance, a compound financial instrument has been issued and it needs to be broken down into its equity, which is equity settled, and liability, which is cash settled component. The equity settled component is measured as a residual consistent with the definition of equity by comparing at grant date the fair value of the shares alternative and the cash alternative. The fair value of the share alternative is $108,000, which is the 24,000 shares.
The 20,000 shares and the fair value of the option, which is the $4.50. That is the fair value of the share alternative, which we require here, which means in this case here, we have the $4.50 multiplied by 24,000 shares and continue.
Okay. The fair value of the cash alternative is $104,000, which is 20,000 phantom shares multiplied by $5.20.
Is entitled to 20 phantom shares, and as at the grant date, the share price is $5. You can see it here, $5.20, but it is 20,000 phantom shares in lieu. Okay, let me clean this one. Okay, continue. The difference between that 108, therefore, start from there.
Okay. Therefore, the fair value of the equity component of the compound instrument is $4,000, which is $108,000 minus $104,000. The accounting treatment for the liability component.
Just hold on. What we have there is 108 less 104. Is that correct? That's how we have the $4,000. Okay, continue.
The accounting treatment for the liability component and the equity component now follows the treatment for a cash settled scheme and an equity settled scheme, respectively.
Now,
the director must remain.
Hold on there. The liability component is accounted for going forward the same way we account for cash settled. And who can tell me the implication of that as opposed to equity? Who can tell me the implication of that as opposed to equity? Okay, the cash component will be fair value at each reporting date. And that is why you'll find out later why this 610 is relevant for the cash settled, but not relevant for the equity settled. Okay, let's take note of that. Okay, continue.
Okay. All right. The director must remain in employment for 3 years from grant date. So the vesting period is 3 years. For the year to 30th September 2023, Sadler should make the following accounting entries. For the equity component, treat as equity settled. Debit profit or loss with 4,000.
That's 1/3.
Debit okay.
Yeah.
Debit profit or loss and credit the equity with $1,333, which is gotten from 4,000 by multiplying $4,000 by 1/3.
Yeah. And that amount is the expense recognized evenly over 3 years, assuming the director will still be in that employment. And that's what the statement means, which says that the expense as calculated at the grant date is spread over the 3-year vesting period. The equity component is not remeasured, is a key factor you need to know at every reporting date. Okay, but what happened to liability component? It will be remeasured normally for liability at every reporting date. That is why, apart from the fact that it was 5.2 before, now it is now 6.1 within just a space of 1 year. Therefore, you are measuring that, which is far away from 104, is now 104. It was 104 before. It's supposed to be 104, which will now multiply times 1/3, but it is now more than 104. How much is it now? It is 610. My calculator, 610 times 24,000. It's now 146,400. That 146,400 is what you multiply. 146,400 is what you multiply by 1/3 to obtain 48. Can you continue?
Okay. The expense is spread over the 3-year vesting period. The liability component should be remeasured to reflect the fair value of the cash
at each date up to the vesting date. Thank you very much for that. Thank you very much for that. Any question on that? Any question on that? Now you've seen the way we treat, similar to compound instruments, where you have convertible securities under IAS 32. Those are the similar analogy we have more or less harnessed. Any other question? Now, the concluding part, or the penultimate part, let me call it so, is the aspect of deferred tax. Remember, we have done deferred tax. This is just to refresh our memory how we can compute deferred tax implication on share-based payments. Okay, Nudin, or okay, Enaru, I want you to take it up from there. Can you read some things to us so that we can refresh our memory by reading out this?
Deferred tax implications. Since the accounting value of share-based payments is 0, it is expensed. Any future tax deductions, e.g., if there is no tax deduction until the share-based payment vests, we generate a deferred tax asset. Okay. Issue. An entity may receive a tax deduction that differs from related cumulative remuneration expense and may arise in a later accounting period, IS 12 Income Tax paragraph 68A. For example, an entity recognizes an expense for share options granted under IFRS 2 share-based payment, but does not receive a tax deduction until the options are exercised and receive the share price on the exercise date. Okay, should I continue?
Okay.
Should I continue? Okay.
Yes.
Measurement. Should I read the measurements?
Yes, sir.
Okay. The measurement. The deferred tax asset separate difference is measured as carrying amount of share-based payment expense less tax base of share-based payment expense in bracket estimated amount tax authorities will permit as a deduction in future periods based on year-end information. Separate difference. Deferred tax asset is X%. If the amount of the tax deduction or estimated future tax deduction exceeds the amount of the related cumulative remuneration expense, IFRS 2 states that this indicates that the tax deduction relates also to an equity item. IFRS 2 requires that the excess is therefore recognized directly in equity. It is not reported in other comprehensive income, IS 12 paragraph 68A to 68C.
Okay, thank you very much. Now, what we are saying here is very simple. Because tax rule may not allow for deduction all of these expenses that we have recognized in profit or loss with respect to share-based payment, because they are just accrual entries. Tax law might always defer them until it vests when you actually incur by paying cash to them or by delivering that shares to them. Now, secondly, apart from deferring to that date, tax authority might not necessarily accept all of the costs as it vests, depending on the tax rule. Some might tell you that, okay, they only do that on the basis of the intrinsic value or on the basis of the fair value or whatever the tax authority consider from their own tax law based on jurisdiction. Now, what we are now trying to say is that this has created a temporary difference. And in that situation, we need to determine the deferred tax implication on it. And it is clear to us to know that this temporary difference is deductible in nature. Why? Because expense that we have incurred is not allowed for deduction. And in that regard, what happens is that in future periods, such expense, when it is paid for or when the shares is delivered, will be deductible as it vests. And in that situation, it means your future tax liability is likely going to reduce as this instrument become vested. In that situation, we need to recognize deferred tax effect as we recognize those expenses over time. Now, the question then is, to recognize deferred tax effect is very simple. We compare the kind amount of the share-based payment with the tax base. And in simple terms, we compare the kind amount equivalent to the share-based payment expense, which is the cumulative expense, okay, with the tax base cumulatively. Now, the secret there is that the kind amount is always zero because it has already been recognized ahead, okay? While the tax expense will not be the amount, which usually might be based on the intrinsic value when it crystallizes in the future. And to do that, we are going to look at a simple example. But there's something you need to take note of. Illustration. There's something you need to take note of. Okay. What you need to take note of is that primarily the deferred tax arising from this share-based payment is supposed to go to profit or loss. But there are situations where what will be deductible for tax in the future is far above the expense cumulatively that has been recognized. And in that case, what the standard concluded is that it means that excess amount that could have given rise to deferred tax asset will be attributable to the component that has been recognized within equity, which then means that anything in excess of what's supposed to go to profit or loss will be recognized in equity directly, rather than recognized in other comprehensive income. But let us use this illustration to explain it better. Who will read for us? Who will read?
Can I read?
Okay, Anne.
Okay. Illustration. On 1st January 20x2, Bruce Co. granted 5,000 share options to an employee vesting 2 years later on. Later on 31 December 20x3. The fair value of each option measured at the grant date was $3. Tax law in the jurisdiction in which the entity operates allow a tax deduction of the intrinsic value of the options on exercise. The intrinsic value of the share options was $1.02 at 31 December 20x2 and $3.40 at 31 December 20x3, on which date the options were exercised. Assume a tax rate of 30% required. Show the deferred tax accounting treatment of the above transaction at 31 December 20x2, 31 December 20x3, which is before exercise and on exercise.
Okay, now let me just show you briefly. If you remember, if we are to use this on our Excel, let me first of all go to our Excel. This question is similar to, I think, question 2 we've done in our Excel. Okay, let me say question 1. Okay, let me duplicate this. I move it here. Okay, this is deferred tax implication. On share-based payments. Okay, now I'll just take this out. Let me clean all this off. Okay. This is the information we have. If we are to just compute the expense directly, what will we get? This is equity settled. This is 20x2 as a grant date. Okay, and the fair value of the option was $3. Here we use 3 Naira. Service condition, how many years? This is a grant date. Expected to vest 2 years later on. That means it's 2 years. Now the vesting date is X2, X3. That's 2 years. Number of people in the option, number of employee. Okay, they gave us 5,000 share options to an employee. It's just one employee, and 5,000 that employee. Okay, let's leave the issue of number to vest. Okay, these are not relevant. Now, this is what we'll have done for, is a 2-year period. Therefore, 20x x2 and 20x3. Okay, 20x2, 20x3. This is what we'll have done because it's a singular employee, therefore, it's only one staff. Probably is a very key management staff. And we have 5,000 shares, and each one is 3. And we're in the first of the 2 years. Therefore, what do we do? In this case, we only have one staff. This is 1. And that one is entitled to 5,000. And the fair value is 3, and we are in 1 of 2. At the end of the day, this is what we should that's 1,000. Okay, therefore, this is what we should have variably. So let me power my laptop. Okay, that's 7.5. Okay, in year 2, we'll bring the same thing, but now it is 2 over 2. That means it's 15,000, which means each year is 7,575, and that is what we need to recognize. Cumulatively, our equity will have been 15,000. Now that is that. But let's now look at our solution to it. What has happened with respect to deferred tax? This amount, though we have recognized it as expense, will not be allowed for tax deduction until the settlement date. Now, the day of settlement has come, and we are going to settle based on the intrinsic value. And what do they say about the tax jurisdiction here? It was stated here that tax law in the jurisdiction in which the entity operates allow the tax deduction of the intrinsic value of the option on exercise. The intrinsic value of the share option was $1.20 as at 31st December 20x2, and $1 and $3.40 as at 31st December 20x3, and on which the date the option were exercised. Now, what happened in that case? Let me put my spotlight on. Now, what happened is the carried amount, as I've told you, will always be 0, 0. Okay, the tax base will be, instead of using the fair value of the option, we are using intrinsic value because that intrinsic value is what actually will likely crystallize from the angle of the tax law. And in that case, we are using $1.20. And remember, there are 5,000 shares to that person. That 5,000 times $1.20 should give me 6,000 for the whole 2 years. Okay, but this 6,000, we are only going to recognize one for the first year, which is 1/2, because there are 2 years, which is the service period. Now, which is how we got this 3,000. Now, but by the time we got to the second year, the intrinsic value has grown to $3.40. And as at that time, it has gone to $3.40, we already have the O2/2. That's why you are not seeing that 2/2, because 2/2 is 1, and 1 times anything is 30, which means it's embedded in it. Cumulatively, this has given to 17. Do you understand? For the first year, it was cumulatively 6, where we recognize only 3. And second year, cumulatively, it is 17, where we recognize the difference between 17 and 3 is 14, which is like for the current year. Now, but because you know that doing determining your deferred tax, you use what we call the balance sheet method. The balance sheet method uses the cumulative balances, okay? And that's why you are seeing what we have displayed on the screen. Balance sheet method, let me put it there. Now, this is given. Now, this, we obtain it based on the intrinsic value. These are based on what? Intrinsic value. And you know what intrinsic value means? It's the difference between the actual share price and the exercise price. Because in exam, they might not give you intrinsic value straight. They give you the spot price at each reporting date and the exercise price. Now, at the end of the day, the difference between this and this gives us our deductible temporary difference. Deductible temporary difference is what will later result in the recognition of deferred tax assets. If you go back to what we've discussed under income taxes. Now, deferred tax, sorry, this is deductible. The arrow should not go there. This deductible, the arrow should come here. Now, this is what I mean here when I said intrinsic value is what was used here. Okay, now deferred tax is applying your tax rate, which is at 30%, to your deductible. And that is how we obtain an asset. Okay, and it's deductible because the inability of us to deduct it for tax purpose in the current year up to when it vests is like more or less paying more tax today with the hope of paying a reduced tax as at the vesting date. Now, 30% of 3,000 gave us 900, 30% of 17,000 gave us 5,1. Now, this 900, let us go and make some comparison. Now, the comparison I want us to make is this. Because I want to determine whether all of it is what I will recognize in profit or loss, or portion of it will be recognized in the equity directly. Now look at it. This is the accounting expense we did the other time, 17,5 and 15. This is cumulatively as at year 1. This is cumulatively as at year 2. Again, let me show you from the Excel so that you can refresh. Okay, remember, cumulatively, it was 7.5 here, and cumulatively, it was what? 15 here. Now, that is what we brought forward here. And we compare that with what is allowable for tax deduction, be the intrinsic value of 3,000 and 17,000, which is what we have here. And the position which we have earlier shown you is as follows. And what is the position? The position here is this, that if, I'll read it to you now. If the amount of tax deduction or estimated future tax deduction exceeds the amount related to the cumulative share-based payment expense, that portion, as required by IFRS 2, will be that tax deduction relates to the equity item. And that equity item will be reported directly in what? Equity. Now, let us look at it here. Let's look at it here. Sorry, let me clean this up. Okay, that's annotation. Now, when you check it now, this is 3,000 is what was recognized here, which means the tax deduction here is lower. Therefore, there's no component of it that goes to equity. But here, the tax component is higher. It means 2,000 of the temporary difference goes to equity. 30% of that is 600. And that is why you find out that here, upon we computing the deferred tax movement in the first year is straightforward. Debit my deferred tax credit, that is my income tax account, which is credit my deferred tax account in my profit or loss, and the other portion goes to balance sheet, which is debit, which means this is debit to deferred tax asset account, and this is credit to income tax expense account. And there's nothing that goes to equity. That is for year one. But year two, remember this 600 I took from here is a portion that goes to equity. But remember that the difference between 5,1 and 900 is 4,2. 4,2 naturally supposed to go to profit or loss, but there's 600 component of it based on the analysis we have carried out here that is attributable to equity, which you have to separate from the first 6, because the sum of these 3,6 and 600 is the 4,2. Now the 4,2 is split into the equity, the portion that goes to equity to reduce equity, to increase equity, and the portion that goes to income statement to increase our profit by way of deferred tax credit. Now this 3,6 is the 4,2 less component that goes to equity, which is 600. And that gives us 3,600. 3,600 is the component of the movement between last year and this year that goes to profit or loss, while 600 goes to equity. Peradventure, if what we have added here is somewhat 18,000, therefore there won't be any movement going to equity. In that case, what we'll have had is that the entire 4,2 will have been a credit to our profit or loss. And that is that. Any question on the deferred tax implication here? What I want you to do is that for everyone we have done, go and compute the deferred tax implication, provided you have information about the intrinsic value, whether directly or indirectly. And if you don't have information about intrinsic value at all, you assume intrinsic value and see how you will have treated the deferred tax, whether all will go to profit or loss, or a portion of it will go to equity directly. But never will a portion attributable to share-based payment goes to other comprehensive income. Any question?
We should assume 30% tax rate, right?
Yes, or any rate. You know, what you are just doing is you are doing scenario analysis of it.
Okay.
Any other question? Okay, to wrap it up, we'll wrap it up with this discussion. Okay, I want someone to read this up for us and we'll wrap it up at that point. Okay. Special purpose entities, group and treasury share transactions, and we also now wrap it up with the disclosure. Who will volunteer? Anne, can you read it out for us?
Okay. Special purpose entities. IAS 19 originally applied to equity compensation plans. However, when IFRS 2 was published, such plans fell under the scope of the standard instead. SIC 12 consolidation. Special purpose entities originally excluded equity compensation plans from its scope because they were included in IAS 19. However, due to these plans subsequently being recognized under IFRS 12, IFRS 12, it was considered necessary to bring them within the scope of SIC 12. The effect of this is that where an entity controls an employee benefit trust or similar entity that has been set up for the purpose of share-based payment arrangements, the trust will need to be consolidated by the entity. Group and treasury share transactions. IFRS 11 Group and Treasury Share Transaction was published in November 2006 to address two issues that are not dealt with in IFRS 2. The first issue surrounds certain arrangements involving an entity's own equity instruments and whether these are equity or cash settled under IFRS 2. And the second deals with group arrangements involving equity instruments of the parent. The first issue is where arrangements are made by an entity to grant rights to the equity instrument, such as share options to its employees, and the equity instrument, that is, e.g. the shares required to settle the obligation to the employees are to be acquired from the shareholders of the entity or by equity instrument from another party. IFRIC concluded that such transactions should be recognized as equity settled since the entity is entering a share-based payment transaction in which it is receiving services as consideration for its own shares. Such transactions are required to be treated as equity settled, regardless of whether the rights to the equity instruments were granted by the entity or its shareholders, and of whether the rights to the equity instrument were granted by the entity or its shareholders, and regardless of whether the equity instruments were settled by the entity or its shareholders. The second issue addresses where share-based payment arrangements involve two or more entities in the same group. The interpretation specifically addresses how to recognize such transactions in the financial statement of the subsidiary that is receiving the services from the employees who have been granted the equity instrument. Should I continue? Okay. Two specific scenarios are covered by the interpretation. Scenario 1, the first is where a subsidiary grants rights to equity instruments of its parents to its employees, and hence the subsidiary retains the obligation to settle the transaction. In such transaction, the subsidiary should treat the transaction as cash settled. And the second scenario is where a parent grants right to its equity instrument to the employees of its subsidiary, and hence the parent retains the obligation to settle the transaction. Assuming the transaction is recognized as equity settled in this consolidated financial statement, the subsidiary will measure the services received from the relevant employees based on the transaction being recognized as equity settled. The subsidiary will recognize this amount in equity as a capital contribution from its parent. An employee may move between group entities in which case each subsidiary should measure its cost based on the portion of the relevant service it has received. Continue. Okay. Group-based payment transactions. The classification of common forms of share-based payment arrangements in consolidated parent and subsidiary financial statements is summarized below. We have the classification as follows. We have the entity receiving goods or services, entity with obligation to settled in, then the different classification of parents, subsidiaries, and consolidated financial statements. For entity receiving goods or services, we are under entity receiving goods or services, we have subsidiary. Then under entity with obligation to settle, we have subsidiary, and to be settled in the subsidiaries equity. Okay. Then not applicable. Okay.
Now let me summarize what this is saying, is that the way you treat share-based payment is a function of the substance of the transaction and at what level are you treating it. Is it at the parent level as a standalone? Is it at the subsidiary level as a standalone, or is it at the consolidation level? Now the first one is this: if the entity receiving goods or services is the subsidiary, and the entity that is obliged to settle is that same subsidiary, and that subsidiary is to settle with its own shares. Therefore, it has no implication on the parent's book, but rather in the subsidiary's book, it will be treated as equity settled, and it will also flow to the consolidated as equity settled. But if the subsidiary receives the benefits by goods or services, and the subsidiary is obliged to settle, but is going to settle in its cash, therefore, it has no implication in the parent's book, but it has implication as cash settled, which is liability in the subsidiary's book. And that also flows to this consolidated from the subsidiary. Third scenario is where the subsidiary receives the benefits by way of goods and services, but the subsidiary is required to settle, okay? But it's going to settle in the parent's own shares, that is buy the parent's shares and deliver it to the staff. Such has no implication in the parent's book, but it will be treated as cash settled in the subsidiary's book. Why? Because the subsidiary is not issuing its own equity, but it's going to go and take the equity of the parent by way of phantom shares, or this is physically delivered. But at the group level, it will be equity. At the parent level, it is phantom because it's not his own shares. But at the parent level, it will be equity settled because the subsidiary is a component of the parent. And the parent shares issued to the subsidiary and to the employees of subsidiary is deemed to be equity settled at the consolidation level. Now, what if the subsidiary enjoys the benefit? but the parent is the one granting that scheme to settle. And the parent will settle in subsidiary's own shares. Therefore, in the parent's book, it will be cash settled because it's not delivering its own shares. While in the subsidiary account, it will be equity settled. But how we will settle it is that the subsidiary would have treated that equity settled cash share-based payment as an additional contribution of capital by the parent. While in the consolidated, it will also be treated as equity settled. Subsidiary enjoy the benefit, service, or goods. The parent is to settle it by obligation, but the parent are determined to settle in cash. And therefore, in the parent's book, it will be cash settled. In the subsidiary book, it will be equity because the parent has contributed additional capital by way of incurring costs on behalf of the subsidiary. That's why it's equity settled in the books of the subsidiary. Why it is cash settled at the consolidation level. Lastly, the subsidiary enjoys all of the benefit of receiving goods and enjoying services, but the parent is obliged to settle for it, and the parent is to deliver its own shares in lieu. In that case, in the parent's book, it will be treated as equity settled. In the subsidiary book, it will still be equity settled because it's an additional contribution of capital by the parent in the subsidiary, while in the group, it will be equity settled. This is the height of the complication that you can have in a share-based payment. But regardless of the complication, since you have identified whether it's equity settled or cash settled or where it's not applicable, you will now have to treat it the same way you will have treated on a standalone basis, equity settled or cash settled. Any question on that? You see that it's interesting. Complication here brings about interesting things there. And that's why I have to take it over from Anne to explain this diagram. Otherwise, when you read it, you might not understand what it is. You understand? We have a situation where subsidiary is the one enjoying the service of the employee, but it's the parent that is more or less giving that scheme. How do we treat those transactions? That's what we have done here. In conclusion, the following are the disclosures that is required by IFRS 2 whenever an entity has a share-based payment scheme, be it cash settled or equity settled, or the one that has a choice to either settle in cash or in company shares. What do you need to do as an entity? You are required to make a lot of disclosures, and those disclosures are more or less stratified to three main areas. You disclose in order to provide more information that will make users of financial report to have better understanding and to make more meaning about such scheme, the impact that scheme has on the company's financial performance and financial position, and of the company's growth and of its sustainability. And all of this impacts the financial statement of an entity as a result of this transaction, be it at liability level or at equity level or at the expense level, which affect the profitability of the company. Now, what are the things you are going to disclose? The first strata of your disclosure is the nature and extent of share-based payment. What are brought about the share-based payment? What type of share-based payment it is? What is the vesting condition? What is the vesting period? All of those attributes we disclosed earlier in trying to solve the problem are what is required of you to disclose. An entity, therefore, should disclose information that will enable the users of the financial report to understand the nature, the extent to which the financial arrangement via the share-based payment will more or less be exited over a period of time. The second thing is that, how did you measure the share-based payment at fair value? Okay, what model have you used? What are the parameters used? All of these are what will be disclosed. Is it a binomial model, or is it a complex model like the Black-Scholes model? What are the inputs to the model? How was the fair value obtained? And what was the excess price, which is the strike price that has been agreed? Okay, in that regard, an entity should disclose information that enables users of the financial statement to have better understanding and appreciation of the fair value of the goods received or services enjoyed by the entity, and the fair value of the instrument granted. Remember that at the beginning of our discussion, we said normally the instrument granted should be measured at the fair value of the goods received or services rendered, except for services rendered by employees, which cannot be reliably measured other than being measured from the perspective of the fair value of the equity instruments. Okay, and that is key. The final disclosure is the effect of the share-based payment transaction on your financial performance and on your financial position, which means how has it affected your profitability, which means disclose the expense portion of the share-based payment as you report, as it affects your profitability on a year-to-year basis. And also disclose the portion that is reported within equity for equity settled share-based payment transaction, or the portion within the non-current liability or current liability, as the case may be, if it's within the next 12 months to be settled. Disclose such information for the liability component also in the financial statement. All of this will make us to have better appreciation of the whole implication of such transaction that has been entered into by the company with its employees, with its professional service providers, or with its conventional vendors as a blue chip organization. On this basis, I believe we've done enough of justice to this, and we'll bring this to close. But before we have a closure, any contribution or question, otherwise we'll call it a nice day and good night. Thank you very much. God bless you all.
Thank you, Mr. Mewa.
Thank you, sir.
Okay, thank you, guys.